Hey everyone, welcome back to the channel. Today, we're tackling a big question that's on a lot of investors' minds. Is a stock market crash coming in 2026? It sounds scary, I know, but instead of panicking, let's look at the facts, analyze the potential scenarios, and figure out how you can prepare. Remember, this isn't financial advice, but a way to help you think critically about the market. First, why 2026? What's so special about that year? Well, a few economic theories and historical patterns are pointing to it as a potential turning point. One of the most talked about is the 18.6-year real estate cycle, also known as the Kondratiev wave or the long wave. This theory suggests that property markets, and by extension the broader economy, move in predictable long-term cycles. These cycles typically consist of a boom phase, a bust phase, and a recovery. Looking back, we saw major peaks around 1989 and again around 2006, right before the global financial crisis. If that pattern holds, adding 18 years to 2006 brings us right to 2024 or 2025, suggesting a peak could be forming now, with a potential downturn following into 2026. This isn't just about real estate though. The real estate cycle is deeply connected to the banking and credit system. During the boom phase, banks lend more freely, property values rise, and this fuels more economic activity. But eventually, affordability becomes a major issue. Interest rates might rise to combat inflation, and the debt burden becomes too heavy. This can lead to a credit crunch, foreclosures, and a cascade effect that spills over into the stock market. Think about it. When banks tighten lending, businesses find it harder to get capital to expand, and consumers cut back on spending. This hurts corporate profits and stock prices naturally follow. So that's one major theory. But what are the other factors we need to watch? Let's talk about interest rates. For years, we enjoyed historically low interest rates, which made borrowing cheap and supercharged stock market growth. Companies could borrow to buy back their own stock, and investors were pushed into stocks to get any kind of decent return. But now, central banks around the world, like the Federal Reserve, have been aggressively raising rates to fight inflation. Higher rates make borrowing more expensive for everyone. For companies, it means higher debt payments and less money for growth. For consumers, it means higher mortgage and credit card payments. This slowdown in economic activity can be a major headwind for stocks. If rates stay higher for longer, or if the economy tips into a recession because of them, the stock market could definitely take a hit. By 2026, we'll have a much clearer picture of the long-term effects of this historic rate hiking cycle. Another huge piece of the puzzle is geopolitics. The world is a pretty tense place right now. We have ongoing conflicts, shifting trade alliances, and a general move away from the hyper-globalization we saw in previous decades. Any major escalation in a conflict or a significant disruption to global supply chains can send shockwaves through the financial markets. For example, a conflict that affects oil supplies can cause energy prices to skyrocket, fueling inflation and hurting corporate profits. A trade war can lead to tariffs and make goods more expensive, squeezing both businesses and consumers. These geopolitical risks are unpredictable, but they are a constant background threat that could easily be the trigger for a market downturn in the coming years. And we can't forget about technology, specifically the AI boom. Right now, a handful of mega-cap tech stocks, the so-called Magnificent Seven, have been driving a huge portion of the market's gains. This is great while it lasts, but it also creates concentration risk. It's reminiscent of the dot-com bubble in the late 90s, where a few tech darlings soared to unsustainable valuations before crashing hard. The question for 2026 is, will the AI revolution deliver on its massive promises and generate real, widespread profits to justify these valuations? Or will we see a bubble pop, where investor enthusiasm outpaced reality? If those big tech stocks falter, they could drag the entire market down with them. So, with all these potential risks, what would a crash in 2026 actually look like? Let's explore a few possible scenarios. Scenario 1 is what we could call the classic recessionary crash. In this version, the combination of high interest rates, persistent inflation, and slowing global growth finally pushes major economies into a recession. Corporate earnings would fall sharply, unemployment would rise, and investor confidence would evaporate. This would likely lead to a broad-based market sell-off affecting almost all sectors, much like what we saw in 2008. In this scenario, you'd see cyclical stocks like consumer discretionary, industrials, and financials get hit the hardest. Defensive sectors like consumer staples and healthcare might hold up a little better, but it would be a painful period for most investors. Scenario 2 could be a tech bubble burst 2.0. In this version, the wider economy might actually be okay, maybe chugging along with slow growth. But the hype around AI proves to be overblown in the short term. Perhaps the technology doesn't get adopted as quickly as expected, or the path to profitability becomes much harder than investors anticipated. This would lead to a massive sell-off, specifically in the technology sector, especially those high-flying AI-related stocks. It would feel a lot like the year 2000. The Nasdaq would be hit much harder than the Dow Jones or the S&P 500, and there would be a major rotation of capital out of growth stocks and into more value-oriented, old economy stocks. Scenario 3 is the geopolitical shock scenario. This is the wild card. An unexpected event, like a major new conflict, or the collapse of a key trade route, could cause a sudden, sharp panic in the markets. This type of crash is often V-shaped, a steep drop followed by a relatively quick recovery once the immediate panic subsides and the situation becomes clearer. The sectors most affected would depend on the nature of the shock. A conflict in the Middle East would hammer airlines and transportation, but could send defense and oil stocks soaring. A breakdown in trade with a major partner would hurt multinational corporations and companies reliant on specific supply chains. Now this all sounds pretty grim, but here's the most important part. What can you do about it? Worrying doesn't help, but preparing does. First and foremost, don't try to time the market. It's nearly impossible to predict the exact top or bottom. People who sell everything and go to cash often miss the best recovery days, which is where a lot of the long-term gains come from. Instead, focus on what you can control. The number one strategy is diversification. Make sure your portfolio isn't overly concentrated in one stock, one sector, or even one country. A well-diversified portfolio might include a mix of US and international stocks, large and small, companies, and different sectors. And it's not just about stocks. Having an allocation to other asset classes like high-quality bonds, real estate, or even commodities can provide a buffer during a stock market downturn. Bonds in particular often go up when stocks go down, acting as a valuable stabilizer. Second, reevaluate your risk tolerance. Evaluate if the thought of your portfolio dropping 30% makes you want to panic, sell everything. You might be taking on too much risk. It might be a good time to slightly de-risk, maybe by trimming some of your highest flying stocks that have had huge run-ups and reallocating that cash into more stable, dividend-paying companies or into bonds. Third, keep a long-term perspective. Historically, every single market crash has been followed by a recovery and a new all-time high. Every single one. For long-term investors, a market crash is actually a huge opportunity. It's a sale. It's your chance to buy great companies at discounted prices. The fortunes of the next decade are often made by those who are brave enough to buy when there's blood in the streets. And finally, have some cash on the sidelines. Having a dry powder fund, cash that's ready to be deployed, is one of the most powerful tools an investor can have. It gives you the flexibility to take advantage of opportunities when they arise, and it also provides a psychological safety net, knowing you have a buffer. You won't be forced to sell your stocks at the worst possible time to cover an emergency expense. So will the market crash in 2026? It's possible. The cyclical patterns, the interest rate environment, and the geopolitical landscape all present real risks. But it's not a certainty. The economy could prove more resilient than we think, or the AI revolution could genuinely create a new productivity boom that supports higher valuations. The key takeaway is not to be scared, but to be prepared. Understand the potential risks, review your portfolio, and stick to sound long-term investing principles like diversification and consistent investing. also known as dollar cost averaging. By doing that, you can navigate whatever the market throws at you, whether it's a crash in 2026 or a bull market that continues to run. Thanks for watching, everyone. I hope this gave you a clear-headed way to think about the future. If you found this helpful, please give this video a thumbs up and subscribe for more content. Let me know your thoughts in the comments below. See you next time.